So basically, we're starting to hit 100-day lows, and now we're reversing past 100-day lows. And so now that we're hitting 100-day lows, we're literally getting close to 52-week lows. This is getting to the point where we need to really watch here, because either this is going to give us a signal that bonds are going to go a lot lower, and that would be told if we hit these levels and we just continue to move lower. So basically, what I told you up here, we hit a 52-week high, we reversed. We hit a 100-day low. Yes, we came against it a little bit, but then we went right back down. That's still saying that the signal is to the short side. And then if we go a little bit further down, we're going to hit a 52-week low. These signals are going to be very important going forward, because it's going to have a lot to do with inflation, and what's going on with the market. So Kashop's here. So what's up, Kashop?
Hey guys, sorry I'm joining a little late.
Oh, you're good.
It's
How
Friday.
was yoga?
Yeah. Oh, it was great. I
Good.
realized how much I couldn't stretch when I tried stretching.
Good.
So,
Stretching is like it's literally a thing you have to do so much to get to progress in it. And if you
oh yeah,
stop at all, like it just reverses very quickly.
oh yeah, that's true. I
So
haven't lifted. Yeah, go on. Yeah,
no, no,
let's get into the
you're.
show.
So what's interesting, and once again, the people come on here not to just see the finance stuff; they come on to follow us too. So basically thinking about it, if you're thinking about stretching and you want to stretch, everybody should be stretching, especially like if you're trading. Like you should stretch, you should kind of get into the groove of that, because that's going to help you to loosen up and also loosen up your brain. And I know that sounds crazy, but really, it's like if you think about an athlete, for me, I've always been like, I've got to stretch before I do things. And it's not only the stretching out to make me feel like I'm more loose, it's also like to kind of get me in the mood for doing something. So I think it's very similar to, if you're a trader doing the same thing as a trader, um, just to kind of get yourself together and ready to go. So we were talking about bonds just to start things off. So what are you seeing in the bond market today? Anything that's sticking out to you besides this thing massively falling every single day for a while?
Sure. So, I mean, we have to get into the realm of the so-called conspiracy theories to when we talk about the bond market, right? So, starts with Janet Yellen, and we all know what she's been doing. But just to recap, the US has stopped or slowed down the issuance of longer duration debt, which is the 10, 20, 30 years, and they are financing the deficit by issuing treasury bills, 2 year notes, anything on the short end of the curve. Now, the reason they are doing that is because the Fed is also selling down its balance sheet. So they are doing a quantitative tightening, and there's already massive pressure on the bond market due to the rate hikes. So what Janet Yellen did was drain the reverse repos by issuing shorter duration debt, and that way, what's happened is now they have, because the deficit is just growing so massively, they have to keep rolling it over. And when they keep rolling it over, the bond market is getting anxious, and it doesn't help that you have all these legendary investors going out on CNBC and saying that bonds are, rates are probably going to rip higher, which doesn't inspire confidence. So, if you're an institutional bond fund manager and you take a view that I'm going to get long duration, which is I'm going to buy the 20, 30-year-old bonds so that the bond portfolio of my fund is going to have a higher duration than the average. Now, if you take that view and Druckenmiller comes on TV and says bonds are the short of a lifetime or something like that, then the guys who are overseeing the risk, who are your bosses, they're going to ask you, why the hell are you long all these bonds? Why the hell are you taking duration risk? And if you have 1 or 2 months of bad performance because of this, then you're toast. So what's happening is for bond investors, this has become a career risk. And bond investors or any institutional investor for that matter, they don't want to take career risk. They are happy getting their half a million, $1 million paycheck, and it's close to Christmas time. So why would you take career risk? You won't. So when bonds sell off, what do? You follow the herd and you sell bonds. And that's pretty much what's happening right now.
Yeah, and I get that. It makes a lot of sense that you just A lot of people, I think, are kind of interested in. There's two things about it. One, the bond trade is so many people are going. It's cheap right now. We got to buy bonds, which is a ridiculous way to think of anything, especially bonds. And then it's the other end of it is going, okay, well, we can blatantly see inflation's probably coming back. And because we can blatantly see inflation is probably coming back, I would say that, being short the bond market, especially on the long end of the curve, makes the most sense. I think so many people at this point are just beating themselves up in this trade because they have no idea how to trade them from the short side. They just don't want to. It made sense and it made a lot of money for so many years. And that's the thing too is just because you see so many people on TV talking about shorting the bond market, that doesn't mean that the inflows aren't going the other way just because of the way retirements are set up. You have so many people dumped into these bonds and they're basically retirements are just losing money over and over again because they're just dumped into the bond market. And so as they continue to just be dumped into bonds and long duration bonds and they continue to lose money in all of these assets, there nobody's out there going, hey, maybe we should invest in something else, or hey, maybe we should go heavier into stocks, or hey, maybe we should buy some gold. People are just going, yeah, that it'll come back, don't worry about it. You're going to make that yield though, don't worry about it. You're going to make a nice yield in 30 years. Like it sounds ridiculous to people like you and me, but to them it sounds good. It's making sense. Oh, I'm retiring. Yes, my parents own bonds, or I've owned bonds for the last 30 years. So why would I ever stop buying them? They always go back up. And sure,
Yeah,
anything's possible, but mm, I think that the trade is probably somewhere else. Not saying that bonds are the worst thing in the world to own. I just think the trade is somewhere else. It's in some other asset somewhere. Um, and the people just kind of plowing themselves back into bonds, they're going to get hurt, and they continue to get hurt.
yeah, so anecdotal story. 2013, I was working for a Fortune 500 company. We were doing sales to the European insurance companies, and this was the time when Europe across the board had negative yields. So Nestle at one point actually issued a bond with a negative yield, meaning if you bought the bond, you were guaranteed to get back less than what you paid them, and people still bought it. And we did an analysis of who is buying these bonds and what is their rationale. And we found out that it was the European insurance companies, and that's because they had a mandate that they had to buy these bonds, and it didn't matter that the circumstances had changed. They had to buy, and they bought. And I'll tell you the really funny thing here. The really funny thing here is that as these bonds went to negative yield and people bought them, they actually made money, which sounds completely ridiculous, but that's the way it was. And they made money because the ECB was also buying these bonds back from them at a negative yield. And other investors were willing to pay an even higher negative yield and buy the bonds from them. So all these investors in the negative yielding bonds, until a point, they all made money on capital appreciation. Now, it sounds really insane. And it's something that, I mean, it's been 10 years. So if you really and now with real interest rates at something around 6-7%, we can't even think of actual nominal yields being negative. But there was an era where it existed, and people made money trading bonds back then. And even then, there was Bill Gross of Pinko, who was supposedly the bond king of that era. He came out and said German bonds are the short of a lifetime. I think that was 2015, thereabouts. And bonds continued to keep, the yields continued to go lower all the way until the COVID bottom. So you have this guy who's really smart, who's made a lot of money in the bond market, make a call like this, and the next 5 years, the trade doesn't work. And that's just the way the bond market is. It's something that if you just use logic, or if you just go by this is how the world should work, the bond market doesn't work that way. And I've traded the bond futures both ways, and I have seen this firsthand. And I'm sure you have seen this as well. So we know what we're talking about. But when someone of high stature comes out and says this on CNBC, it's going to spook the people who haven't been in the market as long. And I completely agree that you should probably short bonds, but that's really not the trade. The trade, if you think about it, is if you think real yields are going higher, you want to bet against the dollar. You want to buy some emerging market currencies, maybe. You want to buy commodities. You want to buy commodity producing stocks, something, but not exactly short the bond market because I don't think you're going to get the kind of returns, even if you're right in terms of where you think yields are going.
Yeah, I mean it's two different things. So if you break it down, futures trader, yes, absolutely makes a ton of sense to short the bond market. You know, you have the leverage, all of these things, you can make a lot of money shorting the bond market. Retail trader, it makes no sense. You're never going to make enough money to make that make sense. Yes, there's, I think, what is it called? TBT, that leverage short bond ETF. Does it still exist? It actually finally did well after like, 30 years, but I think it might be out. Is it still out there?
Let's check that.
Yeah, I have no idea. I haven't looked at it in so long. TBT. Yep, it still exists. I'll bring it up for other people to see.
Yeah.
So it still exists here. Let's get some of these off of here. I always lose the other one. There it is. Okay. So this is TBT. And so finally, after all of those years of people basically betting on it, which it was just in a massive downtrend forever, and so many people continued to try to buy it again and again and again, and the trades just never worked out until 2018. Or sorry, until 2020. 2018 was when the bond market bottom, so I'm getting confused. So 2020, the bond market bottom and had its last, or 2018 had its bottomed and had its last major rally, and that's where this ends up bottoming as well in 2020, and it starts moving the other direction. We start to finally move higher in yields or shorting the bond market. So you could buy this thing, but I'm not a big fan of the inverse or leverage ETFs. So I would rather see people use the futures. If you're going to do that, use futures. It makes the most sense. But I also agree with you on the other part, which is if you are looking at things to really buy, you're going to want to be in the commodity space. Like, just some of these moves that have happened are insane. Like nobody's talking about any of these moves. Like coffee is insane. That's insane. And once again, the goal here is protecting your money, protecting the client's money. Like this is what we do as our job. So as we're protecting people, like this is anybody can do this out here. People always go, well, it's this type of people who can do that, or these types of people can do that. No, we can all protect our money in some way and learn a little bit about how the system works. And it's a messed up system. The Federal Reserve has made it that way, but it is just how it works. So if you have inflation and your dollars are getting beat up day after day from inflation, you have to understand that you have to put it someplace else. Meaning some of these commodities make a lot of sense. Some of these cyclical sectors make a lot of sense. There's an interesting chart I actually pulled up the other day, Kashab. It was from B of A, surprisingly. I'm going to see if I can find it in my stuff. But do you have any commodities in mind that you're thinking about?
So, we've been talking about corn and wheat for a really long time, waiting for it to bottom. Corn finally looks like it may have, but I am not touching it because there's just been so many false signals like the cocoa chart that you brought up the other day. Now, I know you can sit and do that, take the pain and take the same trade over and over again. I'm not wired that way, so I'm not touching it. But I think this is the time the con trade finally works. And now you see cattle prices making the news. So I don't know. It's just something that's pretty unimaginable. 2022, I think we had palm oil making the news because I think that commodity was up 20x in a year or
Mm-hmm.
something crazy like that.
Yep.
And and now it's cattle. I really don't know where this is headed. It's like uh, the market's playing musical chairs with each of these softs, and Now it's cattle's turn. Now it's cocoa's turn again. And it's always been coffee's turn. It's orange juice's turn. Maybe at some point it's sugar and wheat and corn and soybeans and canola and all the other stuff. So I just wouldn't play agriculture at this point because it's been so frustrating for so long. And I know as I'm saying this, that's exactly how markets bottom, right? Like you have a bear market for a really, really long duration. The grind just gets to everyone, and then you have a crazy move. And oil was the same way. So second half of 2014 is when you should have just completely exited the oil trading business and gone to do something else, because for the next 5 years, if you were in oil, you just got chopped around and you were miserable. And come 2020, what happened? Everyone thought $40 is the floor, it's never going to go below 40, and it went to zero. And from zero, you had this period of chop. And when you finally got a signal to say maybe inflation is picking up, you should get long oil, no one wanted to. Not even the guys who had been pounding the table on oil from 2018, 19, the people I follow, everyone in that community, they were just sick of it and they didn't want to take the signal. And that turned out to be a great trade, which worked all the way until around June of 2022. So, as I'm saying this, I'm aware that I'm kind of contradicting myself that, yeah, this is probably the time to be in agriculture because I've been miserable trying to get an agriculture position going for so long. But then you never know exactly how long the grind will last. With oil, it lasted pretty much close to 6 years. So I don't know how long this will last. And if this is the bottom, great. And you do have buy signals on several of the softs right now, probably take it. But personally, I'm just little sick of it, so I'm staying away.
It's hard. And once again, that's a thing, but it is always hard. And I think and this is also an important thing because you just talked about it like, hey, I'm also thinking now it might be the time. And that's a thing that you have to do as a trader is sometimes fading your own feelings about it. Because sometimes you go, hey, I really can't do this anymore. And then like you're like, oh my God, that's when things start to move. Um, and it's the same thing when you look at the oil trade. You go back to 2016, we're in this massive downtrend in oil. You get a couple pops here and there, a couple trades. If you're a trader, you can make a couple bucks here and there, but it wasn't structurally bullish for a long time. And then next thing you know, you get this last signal that was in November. I think it was November 2020. I think I got a false breakdown signal on oil, and that was be October. And then right after that, I got the long signal on XLE, and then that becomes a massive trend for a while. So it's like, you set up your portfolio the right way. For example, you're only losing 1% of your portfolio when this goes against you. You're making, 20% of your portfolio, or let's say 5% of your portfolio when it goes with you, on average. And then those major outliers like oil you're talking about in 2020, or, corn even in 2020, all the commodities in 2020, let's be honest. That's where you make all your money. So it's just setting up that risk to reward properly lets you kind of let go of it, because really, like, no matter what, here's the thing that I have figured out. Like, people say it to me all the time. They're like, man, you're wired that way. You can take a lot of losses pretty easily. I don't know one trader in the world that wins more than 50% of the time. I don't know one. Day trading, reversal model. Look at we talk about reversal models. Jason Shapiro, he'll be like, I'm only right about 40% of the time. So it doesn't matter what style of trading you do, you're going to be wrong a lot. You just got to figure out what you're comfortable with being wrong on. And also fading yourself. I mean, for me, I always hate certain signals that come in. 2023, I was so mad about the NASDAQ signal or the semiconductor signal. Why the hell would that happen right then? It looked like a recession. Everything looked terrible. And then you try to put on the trade, and that's when good trades happen, like you mentioned earlier. So once again, I don't know. Is this the one? I have no idea, but I do try to think of it as it could be. That's the thing about that you kind of have to do as a trader is go back into, it's possible. It's possible that this is the signal that it happens. We started to sustain over the 200-day for us. We started at this point, we made a 100-day high. Or sorry, at this point we made a 100-day high. And then we just been chopping around ever since. The position slightly in the green, I think, today, very slightly. But recently, we had this pull back into this high volume zone or open interest zone, meaning that it came back to consolidation after breaking out. That's very normal. A lot of people go, what I hate about a lot of technicians is that they do this thing where they're like, they grab a line like this and they go, above this line, I am bullish. Below this line, I am bearish. And if you took the trade and then it closed here, just let's say a penny below 429.49, you get a penny below, and they're like, you're an idiot. Why didn't you just get out there? I got out with a 0.1% loss. You got out with a 50% loss. You're stupid. Really, trading well doesn't work that way, especially for breakouts. Here's the hard part about breakouts. If you're trading this breakout here out of this ascending triangle pattern, here's where your stop loss would be. Here's where your exit signal would also be at that time. So that's pretty far away, and it gives it enough room to run and wiggle around. Like it could wiggle here, come back, and go up. It could also wiggle here and move straight down and hit the stop. But you also just have to be sized properly to handle that. Like a lot of the commodity traders, especially people trading futures for the first time, it's really tough because you get so much leverage, and doing the math on that sometimes is hard. But if you really go through and structure positions to trade at the right size, you can make a lot of money here. But you also have to just understand that it's going to work like anything else. You're going to be wrong a lot. You're going to be right sometimes, and when you're right, you're going to be right, small sometimes, and sometimes right really big. And the goal in trading is to be wrong small, be right big, and don't ever be wrong big. Because when you're wrong big, this is the things that really chop up your portfolio and take a lot of money away. So if you're sized properly for this, especially corn, like there's mini contracts for corn. I think it's YC is the ticker. There's mini contracts for soybeans. There's mini contracts for wheat. I think they're all under Y. I think it's YS for soybeans, YW for wheat. So all of these things are kind of under very similar. They're very similar size, and you can trade these at a very small size and have your stop loss at the right place, have your exits at the right place. But getting back to the trade and the psychology behind the trade, I do think you're really onto something there with going like, yeah, this thing has been frustrating. And most of the time, here's the thing about trading. It's like you think of every small, like for me, flat is under a loser. Flat is damn near a loser to me. It doesn't really matter. But most of the time when you have these types of trades and we get a breakout, what happens is it moves higher. Let's say we hit up, 10%, we come back 10, 15%, then it's a very small loss. Let's say we go up 30%, we come back, 15%, then you have a slight gain. These are this is the way these trend models really work and why they make a lot of money. But also they can be frustrating at times because trading is generally just frustrating at times. But you always have to be ready to take that next swing. And I find myself as I get older, more just fading myself constantly. Like I'm fading myself, my own emotions, right, I feel like like you said earlier, I know you're good at that. I am good at that. However, I hate it. There's not a time where I look at it and I go, this is a perfect trade. I can't wait to get into this thing again. I'm excited about it. It's damn, corn again? Really? I'm gonna take that trade and get, chopped up again? That sounds terrible. Same with energy, or the same with any of these things. Like, man, I'm tired of, the chop. I just want it to work, because guess what? That's what drives us to be good at this. We continue to just fight to be good at this all the time and be the best at it, So you want to be right all the time, but at the same time, you want like you have to have that understanding that I don't know the markets indefinitely. I don't know everything around it. I don't know what's going to happen. I don't know how I know that I can make a model and my model will say to buy. Fundamentally, we have some great things about soybeans, corn, wheat right now, especially the corn market. Weather-wise, if you look at the fundamental picture, you look at supply and demand numbers, all of these things look really good for corn. However, this could all work completely against us. We could get stopped out in 5 seconds, and then we're just stopped. And then that none of that matters. So it's a mixture of being able to fade yourself and fade that emotion of I don't want to do it again because I don't either, to be honest.
Yeah, I think like you're systematic, so gets a little easier over time because you have back tested your system, you know how it works. And also I think this is a let's bring this up. Like you trade around 200 different markets and you have around 10-20 signal setups to trade those. And I follow around 550 stocks where I do mostly fundamentals, but of course I use things like on balance volume, Bollinger Bands, any technical method of gaining an entry. So the technicals help with entry and exit and maybe to size my position, but mostly I just do fundamentals. So when I say I'm frustrated with agriculture, what I do is I just move on. So I'm not going to buy the fertilizers, I'm not going to buy corn. But I did find an interesting small cap idea which I just bought in fertilizers. And so once I did that, I'm like, okay, now I'm sorted because
That
I
was the
have
one from
something
your
that is,
post yesterday, right?
yeah,
Yeah.
yeah,
Okay.
that was the one. Yeah. So I found that and I'm like, okay, now I'm at peace. So I still have exposure to agriculture, but I'm not getting chopped around. And you trade 200 different markets. So, when corn gets stopped out, maybe lumber picks up or maybe Brazilian real picks up. So you have around, how many questions do you have? Like 50 around that?
I can tell you in 5 seconds. Let's see. Um, we're actually only at 23 today. 23.
Okay.
So 23. So it's not it's a you can always try to find the best areas, and that's the thing that we can do as traders. You could follow it fundamentally, you could follow it relative strength wise. There's a bunch of ways to do it. Um, but at the same time, it's like nothing is as clean as just and less stressful. I think that's another thing to be said. It's a lot less stressful to just go, okay, I'm just going to follow the models, the signals, and just put it on over time. It doesn't mean that you can't find something that's the like look at some of the natural gas stocks compared to natural gas. Some of these have been moving very cleanly in a very smooth way, and you don't have to have the exposure to things like natural gas. However, for me on the macro side of it, I never get micro enough to find the things that are going to move like that. The size even for my stocks that I will buy in like my retirement portfolio or something, the size of those are also pretty massive. So they move with the market most of the time, so it doesn't even matter to me. That's why people, if you're a macro guy, you'd follow someone like me. You're a micro guy, you could follow someone like Kashop and really get into the weeds. Because even for me, like there's a lot of times where I'll be like, "Oh, Kashop found something really cool here. I'm gonna try to get involved in that." It's the same with like the shipping stocks. Like if you looked at the shipping stocks, there was times where those were so uncorrelated to the market and doing very well at times where everything else wasn't. And this for me, the most micro I might get on something like that, besides of my retirement portfolio for the fund, I mean, is going to be like, okay, I'm going to trade the energy sector, which is a little less of the S&P 500, but really most stocks, if you're not getting very micro, when things go up, everything kind of goes up. And when things go down, everything kind of goes down. The only thing you really get from finding individual sectors like I do is the outperformance at certain times in those sectors.
And sometimes, if you find a really great trend, like I know you have done that with Vietnam, you have done that with semiconductors, then you just let it ride, and it's amazing how well that can outperform the market. Like, I never imagined you could find an ETF that goes up 100% in a year. It's crazy to even, I mean, not the leveraged ones, right? The regular ones.
I think it's
But
something to do with the times more than anything, because even for me, I've always looked through the ETFs, and I have through the back test, I've seen that there's outperformance, and just in the ETF portfolios, we've outperformed the S&P too. And when I really look into that, I think it's a sign of the times. More people use either buying just the big names. If you think about it back then, like when we started trading or even started looking at markets, people picked individual stocks a lot. ETFs weren't really a thing at the beginning. Now it's more ETFs. You see the ETF flows, you see managers, especially big RIAs. Big RIAs, people running over a billion, even over 100 million. They're all just using ETFs. And so I think it's where these flows kind of come into play. And the reason why you see outperformance in the biggest names inside the ETFs like NVIDIA. Why is NVIDIA doing so well? Well, people are putting money in the semiconductor sector, which really just means I'm putting a lot of money into NVIDIA. And so you see things moving in these crazy ways because so much of that money now is going to only a few names because in those big sectors, they're the leaders. They continue to become a larger and larger part of the ETFs, which at some point that's going to reverse. Like that's not sustainable forever. But for
did
now, it
you
just is the way it is.
did you catch that speech by the Interactive Broker CEO?
No, I didn't.
70% of, oh, so he said 70% of all the trading on his platform is just the Max 7.
Really?
That's why, really, yeah,
that
70%. And
that's
yeah, it's
insane.
crazy. And he is worried about the kind of margin loans that people are taking out, because if the unwind isn't orderly, he is afraid that the broker is going to be stuck with negative collateral.
Hmm.
So that's the worry. And to think that, so Interactive Brokers is the platform used by quite a few of the hedge funds. So it's not just retail capital. So when you have the CEO of that platform saying something as crazy as this, I just think we are probably days or weeks away from the Max 7 topping. Like, those cannot sustain. And if it cannot sustain, something has to happen. And it reminds me of 1989-90 Japan, where the grounds of the Imperial Palace in Tokyo were supposedly worth more than the entire state of California, which is insane if you think about it. And here you have all these sell side analysts, because they've been so wrong with their year end S&P target for 2024. They are just calling 7,000, 7,100, whatever wild bullish number comes to their head. And it just makes me think, like, if they had been prognosticating on Japan back in 1990, what would they have said? Nikki goes from 40 to 80,000. The Imperial Palace becomes worth more than Texas and California combined, something like that. Whereas that was the precise time where you had to fade the prevailing sentiment and just take the other side. And for me, taking the other side doesn't mean shorting it. So this year has taught me that long short equities as a business model is kind of broken. And that's just because the Fed or any central bank just keeps pumping liquidity in, and then you have these gamma squeezes. And you have a stock like MicroStrategy, which hasn't made a profit in something like 2 decades, is getting squeezed into the QCTF. So you have insanity like this. And Palantir, so one of the executives in Palantir put out a tweet saying they had switched their listing from the NYSE to the NASDAQ so that they can squeeze the stock into the NASDAQ 100 ETF. Now, this is just insanity. And to think that all these behaviors are being rewarded, where is the incentive to just do short stocks anymore? And short individual stocks, I mean, it's different if you're doing it in futures or if you're doing it in ETFs, but if you're shorting individual stocks, I just don't think the reward exists anymore. So I switched to a long only model, and I'm not shorting the market per se. What I am doing is looking at value, because every time market got lopsided, value always came back. And I think that's going to be equally true in 2025 and 2026. And the best part is long only with no leverage, I can afford to wait it out. And the really crazy part here is this is the way I'm thinking about it. So earlier, if you used to be a value investor, you had to take 20, 30, 40% drawdowns, sit on a position and have it not do anything to your IRR. And here, what's happening is these stocks are just falling straight down. The on balance volume is bottoming. And after that, there is nothing. So you're not going to take as much pain being long these stocks. It's just the waiting. And the waiting, I think, works in your favor because you can look out at everything that's happening and be like, I'm not a part of this madness. So whenever it ends and it doesn't really matter. And I'm not taking a big drawdown by doing this because the on balance volume has kind of bottomed and there are literally no sellers left. And because this is the season where people take tax losses and value stocks have been in the dumps for so long, everyone's just selling them to offset their gains on the max 7 or whatever. This is a perfect time to buy. Now, that's one strategy, and I know you have different strategies, and that's, I think, what makes these talks good, because we can talk about our different strategies. And I respect the on balance volume, so I always look at that. I don't really care when I'm buying a value stock whether the CCI is at 30 or it's gone wherever it's gone. It doesn't really matter. But I look at the on balance volume, I look at the fundamentals and just take a different view. And I think that's something I'm really excited about doing now. Like
Yeah, I think
completely done with, yeah.
I think generally the idea of shorting individual names is really tough, and even ETFs or anything, like, it's just tough. And there's so many other things to short out there. Like, you could short the bonds, you can short there even gold, any of the commodities if you want to at certain times. Not saying I'm shorting gold by any means today. I'm very long gold, but just saying, like, you can short a lot of things that make money, and everybody's always focused on specific names that are raging to the upside. That makes it very hard to short them, whether you're right fundamentally or not. That's the hardest thing to do as a trader, is understand, like, you can be very right on a stock and also lose money. You can be very wrong on the fundamentals and make money. You can be wrong on your entry and make money. You can do all types of things the wrong way. And the wrong way is just something that isn't repeatable. A process that isn't repeatable isn't a way to make money. But got to end on that real quick, Kashab. I got a hard stop around noon. But real quick, I wanted to show you this. This is the one from B of A. And it goes to what we're talking about, because I completely agree with you. Yeah, I might be long some of these things right now, but I definitely see the relative strength is rolling over in a lot of the tech, big tech especially. Um, but when you're looking at this, it's kind of interesting that how wide the jaws are from the real economy, which is listed here from B of A as industrials, financials, energy, materials, and then the digital economy, which is tech, communications, and consumer discretionary. And so you see those jaws being so wide here. And this is kind of like what Kashap and I are talking about, because really value is going to be in a lot of those areas that are in the real economy, and a lot more. There's a lot more of them to be had as well. And then tech, big tech is extremely overvalued in comparison to the rest of them. So something for you guys to take home. Feel free to screenshot that chart. All right, guys. Thanks for hanging out with us. I will talk to you guys soon.
Bye, everyone. Have a good evening.